All right, let's get to it. This is our intro into stock options. I'll let you know ahead of time. There are a bunch more that you can, a lot of different ways you can use stock options, um, different contracts that you can get, but the main two that we use is what I'll go over, and then the characteristics of those, and then a breakdown of what a recap of what the most important things are to look at or look for when you get in a contract. Um, so let's get to it. So there's two main that we use, calls and puts. So calls are your prediction that the price is going to go up, and puts is the prediction that it's going to go down. And a key to know in all this, and this helps as you get more familiar with this, but the price for either direction you're predicting, it just needs to be going in that direction. It doesn't have to get to the strike price that you put. Strike price is the contract that you actually buy. You buy a, say, Apple, and we'll show on the actual broker, a little bit later. But there's a strike price that you buy a contract at, and it doesn't have to get there; it just needs to head in that direction. Why that comes into play as you become more familiar is, say if you do a much further out option or contract, and it actually gets there, it really puts your contracts on steroids to where you get those huge returns that um or if you do a further out price as well, but it gets there quicker, is going to be the same type of effect. The quicker something gets to your pricing, the better for you. As far as all the eyes that are then become on it, your volume goes up, the open interest goes up because everyone now is like, man, I got to get in on this, but you're already in, so it just makes your contract even more valuable. So like I said, the price just needs to be heading in your direction. And you got to understand the Greeks. And what the Greeks are, you've got delta, theta, gamma, vega, and rho. The main two that we deal with is delta and theta because these from what I've learned, have the most impact on your contract. So the delta is the amount of money you'll get for every dollar increase or decrease if you're doing puts um, in that contract, right? So, you know, we'll see that when we get into the broker, but that's important to know because it lets you know, okay, well, does it make sense to buy just one or, save a few dollars maybe and buy two contracts at a lower or a higher strike price so the contracts would be lower. The delta and theta will show you that, right? And the theta is the time decay. So the longer you hold a contract, the less value it has. So what you want to have before you purchase is you want your delta to be much higher than your theta. Doesn't have to be $100 higher. You're not going to find that type of difference anyway. If you see something that different, something's wrong. But you want it to at least be you want your delta to be higher than your theta. Could be a dollar higher, 50 cents higher. Either way, you just want this ratio to be higher to make sure that you're picking a great contract. And the gamma, these other three here, I don't really, I know the gamma says for sure if something is moving fast, as far as into the price going in your direction, it increases the value of your delta. And I think it may decrease the value of the value of the theta as well. Either way, I know it definitely helps the uh, price of movement to go higher, quicker for you. All right. And then something you also want to know about is the uh, open interest and volume. And what that means is The open interest is just the number of open contracts. No one's sold anything. They just bought them and they're sitting with them, just letting price do what it does. Um, how that comes into play on the mental side is, if you bought something and let's say price is gone, this is just if you don't even have your own price target, but you're just getting into something. Let's say you get into something and the open interest, of course you have to keep flipping back and forth and keep an eye on it. But if the open interest is either going up or not decreasing, it lets you know that the people that are holding these contracts, they're expecting more, more of a price, uh, the price to move more in their favor. Um, Not saying that that's a sure thing that will happen, but there's a reason why they're not selling it just yet. A lot of people can fall into greed and just think, okay, well, if it's moved this fast, this quick, or if it moved this much this quick, um, then we can predict um, that the maybe it'll go higher even more faster. So we just want to make sure that don't take that for granted and just think that that's exactly what's going to happen. Um, but that is something that you can use um, to just add to your thought process. The volume is the number of contracts that are being traded in that moment. So you want your volume to be you want both to be high, open interest and volume to be high. You might see these both high, and that can be because the contract price is so low. So don't get fooled by that. You want good value on your contract because people can buy a whole lot of $10 contracts and just hold them just for maybe it does do it. So I'm not saying get something like that, but you want your open interest and volume to be high. And the volume is just letting you know that people are moving these contracts currently. The higher the volume, the more probably that the price is moving. Either it made a big move, that at open or intraday, something happened to start to make that price move. So um, just keep an eye on that. But like I said, you want you want good open interest and good volume. When I say good, I'm looking at least a thousand contracts open, and then even 1,000 either being sold or being traded in that moment of me purchasing the contract. So implied volatility is also something you want to pay attention to. So that is speaking to how fast the price is moving. So, you may think that that's a good thing, but it depends on when you've gotten in. Like if you're already in and your implied volatility goes up, you're good. You're now selling to the people that are, for lack of better words, chasing the price now. So you can sell it at any time. You can not any price you want. You don't want to go too crazy. Like I said, greed is a big part of this, but you can be comfortable selling at the ask price. We'll look at that. We'll get to that soon here, but you can sell at the ask price and be comfortable with it filling, your order filling. But buying a contract that has high volatility is not a smart thing to do because you can get into something and if the volatility is high, let's say you just jumped in it, delta and theta look good, but you just got in it, and like I said, the volatility is high, your contract, it can still lose like 50% as soon as you get in because of the way the price is moving. The volatility in the market is going to hurt that contract more than it benefits it. If you're just now getting in, if you're already in, like I said, you're just watching everyone react to it, and that's their fault for getting in afterwards or getting in with high volatility. It's a chance you take. It's a risk. It's a higher risk that you're taking if you're getting into something with high volatility. And then what I was talking about there with the ask price. So the spreads, you got a bid price, you got a mid price. It doesn't show here, of course, but just think that there's a middle price here, and then ask. The ask is the highest you're going to pay for a contract. The bid is what if you're trying to negotiate, uh, just because you've got a number that you want to pay for it, or you just have a set number that you want to pay. Period. Like I want to pay $1.50. I'm not paying more than $1.50 for a contract. So if it's ask price is $1.60, you got to wait for it to drop back down to your pricing. Um, in some ways, that's a uh, it's good to do that to think in that way, but in some cases, you're kind of going against what you think. If you're looking to enter right now, you think it's going to go lower. Why not just wait till it goes lower, right? Instead of purchasing it now and maybe or putting in an order now, tying up your funds to get into that. It's just why not just wait, really? But it's not something that's not something to be against doing. You could just set this price at the bid or set your price at 150, and if it fills, it fills. But you might miss a move if you're waiting on it to get to your price. Whereas the ask, if you're confident in what you're looking at, thinking, hey, this is going up. I don't think it's shooting straight up, but this is I want to get in now. The move is happening now. You take the ask price and you know let the chips fall, right? It's not a risk that you're taking because you've done the work. Your delta and theta is good. The charting, which we'll get to next week, the charting was good. This is what I looked at. This is why I'm looking at this. Um, but the main thing that you want to know is the spread price, the spread of the price between the bid and the ask. You don't want that to be too high, right? Too high to me is I don't want to spend if the ask is 260, I don't want the bid to be 160. That's a dollar difference between what the spread is. That's too high for me. Um, I like it to be about 10 cents, 20, 30, m- maybe even 50, but I don't really go much higher than that simply because I just don't like that much of a gap between what I'm spending, and also the possibility of how far it can drop. So, you think about the volatility. So I pay 260, the bid's at 160, the volatility maybe kind of high, maybe let's say 80%. Good chance that when the market, whatever's going on, it could drop. So I can get in this and within seconds, it'd be back down to the bid price. So I've already lost a dollar in value. My contract's probably looking crazy at the moment where I'm like, man, what the heck? I'm down 50%, whatever. That's where the mental side comes into this, the emotional side where you're now thinking, was this wrong? Did I get in too early? Um, and when we do starting, we can talk about stop losses, but all these things that your stop loss can get hit as soon as you get in. You're like, man, I did that wrong. Not necessarily. It's just maybe there was some factors in the contract itself that went against you that you maybe didn't notice, or if you do these things, if you pay attention to these things, I think you'll have a better chance at getting a good contract. Uh, we the technical side, the charting side, that's going to be sharp. So it lowers the risk of something going against you. And these are things that you want in an options contract. So, like we said, talking about the Greeks, you want your delta to be higher than your theta. You want your time decay to be less than the amount of money you make per dollar move. Over time, theta being higher is going to hurt you. You want high open interest on longer term plays and high volume on short term plays, but you definitely want a combination of both. That's just good practice. Just to nurture that is a good thing. A longer term play having higher open interest is going to be good. And just let you know, it gives you more confidence that there's a lot more people that are thinking this is going to take a longer amount of time to happen, and you can breeze through different contracts to see, who maybe a week out open interest isn't as high as a month out, which more than likely might be wise to go with the month out one, um, just because your theta and your delta ratio is going to be even better on those because the further out you go, the lower or the better your delta and theta ratio is going to be. Um, you want low implied volatility. We talked about that, where the price, if it's moving real fast, it's not going to be a good thing. if you're getting into a contract. If you're already in it, then now you're just waiting for your target to be hit, or maybe you've got a runner left, maybe you've already sold some and you're just leaving a runner or two, and it's just, hey, well, whatever it gets, I'll set a take profit number, and if it gets there, it might get there quickly. It doesn't matter. I've already won because I've taken profits along the way. And you want your bid, mid, and ask prices to be not be spread far apart. Uh, like I said, 10 cents, 20, 30, maybe as high as 50 cents, I think are good numbers to play with. But beyond that, if you go any higher than that, then it just makes it a little bit more of a risk of and a challenge on your mental and emotional side, because now your if it's a the spread is much higher between those numbers, then any movement in the wrong direction is going to start to hurt more. And you want enough time in your contract. We talked about um, the difference in a weekly contract and a monthly contract. Is going to be a better your delta is going to be higher, your theta is going to be no, your delta is not going to be higher necessarily, but your theta is going to be your delta and theta ratio is going to be better. Um and you're going to pay more for the contract because it's further out, but with the delta and theta working with you in a better way, it will help to offset that. The cost of doing business is not going to be as bad, right? So that's the gist of what it is for trading stock options, and learning what the components are that make up a good contract. Those are things that you definitely need to pay attention to. I'll have a PDF for this that I can send out with the that we'll put in the lessons section, but just so you can kind of review. But yeah, that's the main thing. So let's look at let's look at what a actual contract looks like. So I trade QQQ a lot, and I trade them a lot because they have a lot of, unlike a actual stock, they have contracts that you can get any day of the week, really. Whereas say like if we're looking at Apple, Apple only gives you weekly. So, you get one that ends Friday, they end on Friday. So, if the market's open on a Friday, it ends on a Friday. So you can only get weeklies for them, but with this, you can go any day of the week. Um, and so the things that we talked about. So this is Weeble, by the way, and I like Weeble. I've been using them for a while, and I started liking them because of their charts. Their It just was much easier to use, helped me, get better with charting right within my own broker. They don't have all the indicators that like a trading view has, which that's what I use primarily now. I'll use Webull just to set my price alert. So that way, once something triggers, I'm right back in it to get into whatever type of play I'm looking at. But um, for charting purposes, yeah, I use trading view. So let's see. Oh, why I like Webull? It's got a lot of information. They even have like people that you could I think they've got some, yeah, so different people that are talking about um that particular stock or ticker or whatever. Um I'm not saying these people know exactly what they're talking about, but it's good to see what maybe some people might share some news that you didn't know about. And you can find some things there. But there's a lot more wasted information in here, but sometimes you can find some good people. And just like anything, you want to see something that's got a lot more um, interaction. It means usually someone is either known on here or their, opinions may be valued a little bit more than others. So just a lot of that comes into play, but also if you're looking to actually invest in these different types of stocks, you can get analysis. Well, no, not for uh, um, ETF, but like the analysis on Apple is that it's a buy. 45% of analysts are saying it's a strong buy, and then a lot of people are saying to hold it, and it's got a high price target of 325 uh Currently, the average is about 252, which is close to. So, these are things that you could look at. Like, hey, I think, well, if that's the average. Average sounds doable, right? So, maybe looking at calls for 252 since it hasn't gotten there yet. But, that all depends on how you chart it. But going to the option side. So, strike price is the price that you think ticker is going to get to, the direction you think it's going. Right. So if I was to call this out in the group, I would say I'm looking at the 550 or QQQ 550, 540 call, 540C, and my expiration is up here. So QQQ 540C 218.25 Expo expiration, and the price that I paid is going to be the ask, so $1.21. So I got in at $1.21. I do that to let people know exactly what price I paid, so that way if they maybe catch it later, if I paid $1.21 and you see it as $2.21, you've already missed out on it, moving a whole nother dollar. So you got to weigh the options there. Does it make sense? Me, I don't play things too long. Um, so probably I would have, if I got this at $1.21, I probably would have played it, depending on what I charted. But just thinking about it, I'm probably looking at a double up. So at least 240 and then be on to the next thing, right? But um that's why we do that. And then you look at the implied volatility uh on these types of tickers. These are ETFs, so they've got a bunch of different holdings in different, different stocks. So they're not going to be probably as high as a stock individual stock would be, but 7%, that's great as far as implied volatility. Open interest, 5,000 contracts, and the volume is 89,000. So this is a good contract. Looks like there's a lot of going on there. The delta is 36 to 22 on the theta, so that's a good ratio. So yeah, this is a good contract. I would take that if that was something I was looking at, and set my stop loss at whatever I'm comfortable with. Typically if I buy something at $1.21, I'll say I'm comfortable with it at least getting down to maybe 70, 80 cents. If it gets down that far, then maybe I would think that, okay, this probably went against me. I'm not sure. I can't tell you the percentage, but you can basically just take away, 10 cents and so forth to get your percentages of uh where you're at, or what you're comfortable with. But a good rule of thumb is about 20%. 20 to 30% is a good rule of thumb to use to say that, okay, this is a play that if it goes 20% lower, 20 to 30% lower, maybe I got in too early. 20% to 30% higher, that's a good spot to take some profits. You can take all your profits right then and there, or you can just take some and um, leave more to get more. But at least you got at least 20% out of that. Um, and yeah, that's a contract. That's all you're looking at. You get more familiar with these. It's the same on the put side. It's just instead of, so if you're looking for more options, you'd be going, of course, you're going down for calls. For puts, you'd be going up because you want the price to go lower. So you'd be looking up this way, right? But yeah, it's the same scenario. You want your delta to be higher than your theta, and you just keep going. So you can see there that on the put side, it didn't get, it starts to get worse after this first one here, where it's about $3 difference there, and then it gets about the same as you go through. But the only one here, as far as puts in the delta and theta, that would fit the criteria for great is this first one here, the 535 put. And even the spread is crazy. There's only 1 cent difference between the uh bid and ask price, but and then you see a big jump though, as far as so these things we can talk about, like, why are these such a difference? It just lets you know that there was more value, because this is still going off of what happened on Friday. So there was way more value on the call side. That's why there's a big difference in the prices here. Um, People were just playing calls. I believe QQQ was up more than it actually was what it closed at on. on Friday. Yeah, let's see. It was as high as 538. So yeah, it was as high as 538.84, and it just closed. So um well, there you go. It opened at 536 and then it got as high as 538. So that was a good move for it. Um so yeah, people just were making a lot of money off that move. So and then I guess a brief um chart lesson here. You know, you can just look at this. Some people just look at these types of trends here, right? So let's see, you know, QQQ got to 538.28 here, and then it dropped. And then, you know, you see it went back up here, then it dropped again. So just looking at this, you see right here, high, then it started making lower highs. That's a lower high, that's a lower high, or lower high, lower low, lower low, lower high, lower low. And now it starts to make some higher lows. Hasn't made a higher high until right there. So you might, you know, you caught it started going uptrend and then it gapped down again, but it still didn't get back down here to this low of this area here. Still pushed back up. So it still is, you could see, you know, just looking at this, you can see, okay, the thought about right here would say, it didn't close, and then it started making higher lows. So you could have got in here and said, I'm a challenge to see that it goes back up to try, you know, take out this high here, which it did, you know, 538.28, then it made 538.84 on Friday. So, but you would have had to sit through some stuff, right? So you'd have got up there and but you know, the entries are key, you know, so you got in around here at 523 or so and got to see it get to 531 and it dipped. It did dip and then it dipped back. Probably you would have been, if you didn't take any profit here, you probably would have been back in the red here right on that day. But then it also didn't break this low that it made where you got in, you know, which triggered you getting in. And then it continued to push up and made a new high on Friday. So that's just looking at a chart. You know, that's all it is. Everything is in a pattern. You know, it all moves. At some point, it gets back to where it was, or it trends. You know, whatever this kind of setup is, you probably would see it somewhere else later on in the chart, and it did the same thing. So, but yeah, that's what we got. I just wanted to show you guys that, and then like I said, we will be doing some charting this coming week, so we can just add to the tools and you know just be better equipped for this market. All right.